Welcome everybody to another episode of Leverage Addicts. I'm your host, Blandon Long. I'm with Mortgage HQ and Wealth HQ. And today I have Zhiyang sitting across me. If you guys don't know already, Zhiyang is one of our top mortgage advisors and he is one of the top advisors in New Zealand. And today we are going over the property tier list. And what we're going to talk about are 10 strategies. Now, normally with a tier list, why wouldn't you just download and look at, what's at the end? Well, the reason why we're going through it is because we're going to give you all the details of how we think about all of these strategies and sort of how it stacks up against the 3 C's plus an extra 2 C's that we have not talked about on our YouTube channel just yet. The 3 C's we talk about in the property strategy are number 1, cash flow, 2, a property improvement, capital improvement. The third one being capital gains. And the 2 other C's that we're going to talk about is 1, your commitment level, how much knowledge do you need, how much time do you need to execute on the strategy well? And then this second C is to do with your capability, how much cash requirements you need, how much servicing you need. That is going to be taken into consideration. Now, there is no script to this. It's literally, we are debating here. So Zhiyang is going to pretty much, have some insights on D strategy because he sees a lot of properties. And in the last 24 months, how much deals have you done?
Can't even keep count, Lennon.
In the 24 months, I would say might be over 300 million.
Probably around there.
To do 300 millions of deals, you actually have to go through a lot of properties and a lot of analysis with the client. And so Zhiyang has a lot of experience. And also the reason why we're going for the tier list, because there's one thing in common about me and Z is like, we love to do gaming and property is like gaming sometimes. And maybe Zhiyang, just to kick off, I'd like to know, what sort of gaming have you sort of had in your life that you feel like it's a big influencer for?
Gaming wise, probably started since I was a little kid. The first game that I played was Pokemon. I think the Landon is pretty similar as well.
Really?
Yeah.
I didn't know that. Which color did you play?
Oh, all of them.
Because when I was 11, blue came out, blue and red, I think 10, 11. You would have been a bit older.
Bit younger.
A bit younger. Yeah, sorry. A bit younger. Sorry.
Yeah.
What I mean is you would have newer color.
That's right.
When you started.
Yeah, I think when I started, it was silver and gold, and then went to Pokemon Sapphire. That was my go-to at the time.
Sapphire. Yeah, I haven't actually even tried that. I only played up to silver and then picked up emerald later.
Yeah, but you're too old, Landon.
Yeah, I am. But later on, obviously gaming translate to competitive sports. You were top tier table tennis player.
Yeah, more or less.
A lot of national competition, international competition as well. And so there's always some sort of tier ranking, especially right now. What sort of games do you play in your recreation?
I play a bit of League of Legends. So
nice.
There's always what we call the meta, which is who is, we have a tier like this as well, right? Who's strong at the time. There's always the S tier, A tier, B tier, C tier, D tier. So, everyone wants to always play the S tiers.
Yeah, nice. And for me as well, I think one of the most competitive gaming period I did was sort of like the World of Warcraft and the Guild Wars period. The main thing was like the PvP drive, which is like people versus player or player versus player. And you're going in teams and you're trying to beat the other team. And why I find that fascinating is that in properties, if you want to do these things well, you have to build the right team as well, right? You have to build the right team and then you go for the strategy that you can sort of repeat and get really good results. And so I have on my screen a tier list sort of prepared with 10 strategies that we're going to go over. We've got double settlement strategy. We've got the land banking strategy. We've got the property trading strategy, new build strategy, house hacking or home and income, central do-ups, multi-unit strategy, regional cash flow, minor dwelling, and subdivide to build. Now, I want to change this tier list slightly because there's always a Uber tier. And then we've got the S tier, A tier, B tier, and we don't have deep tiers because C's get degrees. Now, the thing is, if you execute on any of these strategies, you are going to, pass. That's the thing about properties. It's like if you hold it long term, you are going to pass. So there's nothing wrong with any of these strategies, but how do they sort of fit in on the 3 C's that we talk about and like a capability level, how much commitment you need, and then also how much knowledge you need. Those are the things that we're going to consider today. So let's start off with the first one. double settlement strategy. What is this, Zhiyang? Maybe you can tell us a little bit about this.
Yeah, so double settlement is essentially, it doesn't require too much commitment in terms of your equity or your deposit required. All it is you finding a really, really good deal. You might ask for a long settlement date. You also might ask for early access to do some renovations if you wanted to. But essentially what you're trying to do is you're trying to find a buyer before you buy a property, you want a long settlement date, and then you want to sell that house before you want to settle on the same day as when you sell it. So it doesn't actually, you don't need to essentially settle the house. Someone else is settling it for you and you just make a margin there. So I would say, did I miss anything?
I think sometimes you could have a short settlement, but you just need to find a buyer that would accept the deal on the other side. Essentially, you're just selling a piece of paper. You say, hey, I've got this property under contract, and then you're selling that piece of paper to someone else for a margin because you bought it for really, really cheap. And so this strategy is relatively, for most people, very scary, but the risk, even though there's risk, the rewards are pretty high. So what have you typically seen in this strategy in terms of like how much people make on a per contract level?
It really ranges. Ranges from like not much to up to $100,000. Or even more, right? It just depends on your negotiation skills and the deals that you find yourself. Essentially, you're just trying to find below market value significantly, and then you're just trying to sell it at market or even above market. So that's,
yeah. So typical, I would say maybe I've seen 10,000. If someone just doing a quick flip, 10, 15,000 is quite normal.
Yeah.
But if you're quite ballsy and you can go unconditional on the contract and then sell that on, we have seen in the boom market, you could make 3, 4, 500K on a contract like that. Where would you rank this? Like now, considering you don't actually have capital gains in the long term, but it's instant equity because you're just making money on the contract.
Yeah.
Not much capital improvement. Maybe if you got early access, potentially renovate the property and then on sell.
Correct. Hard to say. I think it depends on the individual as well. For some people, if they're short on equity or if they don't have too much equity, this is a very, very great strategy for them. For a lot of people, they already have quite a bit of equity built up. So I would say maybe around the A, maybe.
All right, let's leave this one on the A tier. I feel around the same. It's not actual Uber tier because, it's a bit risky, hard to execute. You could lose money really fast as well. So, okay. So moving on, let's talk about relatively similar strategy would be property flipping. Because if you can't on-sell the contract, you might need to have a plan B in place, which is to settle the property and then see if you can add value and then put it back on the market to sell. So that's property trading. What's the typical margin you've seen sort of clients do on a property trade?
Yeah, it really depends. I think it depends on the deal itself, but from a percentage point of view, margin, I'd say around anywhere from like 5 to 15% from what I've seen. But like I said, it ranges. It varies largely depending on the deal.
Yep. So 5 to 15%. What Z is trying to communicate here is if you bought $1 million flip, you better be making at least 50,000, but you spend the money for renovations, it might be 100,000. You've got your holding costs, could be 50, 60,000, and then your agent's fee, another 30,000. Now that's already 200. So essentially you buy a property for 1 mil, you might have to sell it at like 1.26 before you make that 5% margin, right? So that's very, very important. And sometimes when you see the deals on oneroof.co.nz talking about like, hey, this guy bought this for 500,000 and sell it for 800. It's not communicating all of the holding costs, the GST, the agent's fee, the actual reno costs. So those are the things that needs to be considered. Now, in terms of how hard is it for property flipping? How much knowledge do you need?
Say quite a decent amount. You have to have some form of knowledge. Yeah, you need to know how to understand what the market value is for each property. You need to understand costings for the renovations. You need to understand the values, the holding costs and the value for the end product. So I would say, it's not for everyone. You do need to get some experience and some knowledge.
I would say the most important thing that I've seen successful traders do is they understand just if they understand a few suburbs really well, and when a deal comes on the market that is well undervalued, they know straight away. So where would you rank this? Is it higher than double settlement or lower?
I would say similar. I would say, around the A strategy as well, because it still requires a lot of, decent amount of time finding the deals, renovating the properties. So I'd say, around the A.
Now, I like to counter argument to this because I feel double settlement is riskier, but both of these you're not holding. But double settlement is fast and way easier to execute. It is riskier, but it's easier to execute, and you don't have to hold on to the property. You don't have to resell. So if you can execute a double settlement well, I would say it's better, even though it's less money, because you don't have to do all the project management and stuff. So I would rank it B. What do you think?
Yeah, I think depends, because sometimes the property flipping, you can have a bigger margin, right? You should expect a bigger margin because you're putting in more work. So yeah, I wouldn't argue against B, but I would say A or B.
We'll leave it here for now until we see further strategies. Now, I also like to maybe add one more counter argument to see if you would agree it's B. The thing with double settlement is like once you on-sell it, you get the deposit back, right? Whereas you might have a longer time frame for trading to have the capital locked into a deal. Whereas double settlement, hey, you found a buyer, you get the deposit back, and you can go on to the next one.
Yeah, I think there's less equity commitment required for a double settlement, whereas like property flipping, you have to at least put in 35% of the deposit and the renovation cost. So yeah, I wouldn't argue against that then.
Let's go. All right. So building on to the next one, I think maybe sort of similar price range. Would you say maybe like a regional cash flow strategy might have similar monetary commitment? Probably like lowest equity out of the strategies that we have on screen. Maybe regional cash flow would be the next one that we could look at. So regional cash flow, maybe you tell us a little bit about this one.
Yeah, so regional cash flow is essentially you're committing a bit of your equity or a bit of your cash into buying a property where you hold long term. And what you're trying to do is you're trying to buy a property where it's at least cash flow neutral, ideally positive, and you're trying to hold it for 10 years, 15 years, 20 years. It's not going to cost you anything, ideally, to hold, and we're just banking on the capital gains long term. So obviously there are instances where the rates come down, then you'll have better cash flow. When the rates go up, maybe you don't have as good cash flow, but overall what you're trying to do is you're just trying to hold something for a long period of time.
Yeah. So essentially, maybe you'll have something that's neutral. You don't have to put any money in. And so it's more sustainable, but it's also the foundational strategy. If you look at majority of property investing books, they don't say like, hey, I bought like land banks or like I bought new builds. They didn't talk about that. They bought cash flow properties, old do-ups. That's the foundational strategy. And a lot of massive portfolios are built on that. But what are the downside to this?
Before we go to the downside, I think the way you got to look at property investing is it's like a business as well. And the fundamentals of a business is obviously cash flow, right? So that is why, as you mentioned, most people, solid investors, they go for the strategy as well. The downside to this, I would say one of the biggest ones is a lot of the operating costs. Like, for example, insurance and rates. Those are actually similar to like a Auckland property, for example. Like you might have like a property and the gross yield looks pretty good. It might be, 8, 9, 10, 11%. But then when you're holding a property, the insurance is the same as a 1.5 mil property in Auckland. The second thing is the maintenance, right? Like when you want to change like a kitchen or a bathroom, it's the same as in Auckland as well. So from a gross yield point of view, it's much better. But in reality, the real cash flow, it might not technically be as what it seems.
Yeah, definitely. And I guess the other downside is like once your portfolio is bigger, you need to do so many more transactions in terms of regional cash flow. You've got more projects to manage. So I think that's probably downside once you have more equity and you're looking to really make an impact on your portfolio. But in saying that, actually, there are some big blocks of units that clients have bought. So where do we rank this? Is this sort of S tier or Uber tier?
I would say probably in the S.
Yeah,
S?
Nice.
Yeah.
I would agree. So let's move this guy into the S tier. And the next strategy that might be similar is probably a new build strategy, relatively low requirement on deposit. Maybe you can walk us a little bit through on new build. What does that entail?
Yeah, so the new build strategy is essentially you investing in a property that's been, it's a new build, obviously. Typically what happens is, you might have developers out there, they buy a large section, maybe 600 squares to 800 squares. They might build, 5 to 8 townhouses on there, and they want to sell that to the general public, right? So typically it's going to be deposit requirements is a much smaller than if you were to go for existing house. So you could even go in as low as 10% deposit for an investment property for a new build. What a new build is essentially you're going to get a new shiny house, but very, very little land. The people that do go for it, usually people that, want very, very little maintenance, very little, they want to invest in property, but then they sort of don't want to be too hands-on, I would say.
Yeah, so I would probably build on that as well. Obviously, the massive advantage is low equity required. You've also got the government, saying, hey, you're going to have tax deductibility. It's already healthy home standard. You don't need to do much work. But the amount of cash flow required is likely going to be on the higher side. And because you've got little land, it means that it's potentially going to not have as much capital gains in the long run. And I think you do kind of need to be in a position where you're willing to, deal with negative cash flow for a little bit, right?
Yeah. So I think I've done a few numbers for clients lately. So even a new build in Christchurch returning, 5.5% yield, you're looking at 100% finance at least. You're looking at around at least negative $25,000 cash flow. So that's even having the deductibility, you're still negative $25,000.
Yeah. So I think it's a decent supplementary for a portfolio, but it shouldn't be like the only strategy you have in your portfolio. I think, if it's like one or two where you're like, you could see your family having holiday there, like in the future, send your kids there for uni. I don't know, maybe you have some other use for the new build. Maybe that's a good way to plug into your portfolio. So where would we rank this? Would you say is on par with property trading or sort of like below?
Personally, I took it below. I think what I always tell my clients is, look, when you're looking at the 3 C's, right? Capital gains, capital cash flow, and capital improvement. Basically, there's no capital improvement. We can't really add value to a new build. Cash flow, as we discussed, not really there. And then capital gains, it's arguable. There's probably not enough stats for us to make a judgment on that. But fundamentally speaking, if you're buying a new build and most of the value is in the actual building rather than the land, I would say my assumption is that it's not going to have as good capital gains as properties that have land.
And I would say the other thing to consider is, because there are obviously a lot of new builds, and when we are talking about the tier list here, we're generalizing overall 80%. 80%, you're going to get that kind of result. Of course, there are going to be new builds where developers are just like so good at it. They're very good with the timeline, so they can sell under value, get their money back really quick. They get a really high return on equity, and you're getting a really good product that's built really quickly. So there are also good new builds out there. We're not saying that there aren't, but generally speaking, probably slightly on the lower side in terms of long-term gains. So looking at the next strategy, we have potentially, maybe we can look at minor dwelling. So minor dwelling, what it is like you buy it's a mixture, right? You might buy a cash flow property or slightly lower cash flow, but you could add a minor dwelling where you can increase the total yield of a property or the return that you're getting on a property, like 1.5%, 2% sometimes, because the minor dwelling, the return on costs, you're really wanting to look at something that's going to give you 10% plus. Otherwise, you kind of don't want to do it because you can just buy it, right? If you're only getting like 8%, you might as well just buy the property, right? Because now you're getting instant equity if it's an old build, and you can renovate it to add value. So minor dwelling, you really want a return on your actual cost of 10% plus, because now you're losing some value on your initial property, right? You're losing some land to the minor dwelling. So that's sort of what minor dwelling is. But the upside is you have pretty easy to execute. You don't need that much equity to maybe execute it. If you buy something that has a little bit of equity and we can revalue with the minor dwelling built in, we can probably borrow the money. So anything to add on that?
Yeah, I think it's quite dependent on the location as well. Like, for example, if you're doing a minor dwelling strategy in Auckland, in a place where the land is very, very valuable, it's probably not going to make too much sense, because that land could be used for like a full-size development. But what we're doing there is you're putting a small dwelling on there that's going to take up space. So there's an opportunity cost for a minor dwelling in Auckland. But whereas if you go to the regions where the land is not as valuable, then I think it makes a bit more sense. So it just depends really where you're doing it.
I would say probably if you're looking at Auckland, you might consider the zoning on the land as well. Obviously, there is what we call the single housing zone. Potentially most of it's going to change to suburban, which you can build like 2-story. But we don't know yet because the government is changing their mind all the time. But definitely if it's you build a minor dwelling on a terrace apartment zone land, definitely that would be a waste and you're not getting as much return as you should. So where would we place the strategy, like to buy a house to build minor dwelling?
I would say between A and B, personally.
I give it the higher side because I feel it's a relatively safe way for mum and dad investors. You can buy a existing old build with a bit of equity, and if you're thinking day one that it's got enough land for a minor dwelling, probably have enough land for a whole house, really. So you are actually going into a deal that already has some long-term value, even if you don't buy something that you can build a minor dwelling on straight away. Thinking about the next strategy, how about we look at house hacking and home and income? So this is what David did. Actually, David used to work for us, one of our advisors. He decided with a couple of mates, you know what, we're just going to buy a house where we can have as much income as possible, and then we can exit it because it's own occupy. Once they build up with more equity, if they buy undervalue, they exit that property and they'll have tax-free gains because it's own occupied. Have you seen much house hacking strategy in sort of your last 6 months?
Not too much personally in the last 6 months. Yeah, I mean, home and income strategy, it's never terrible. You've got another source of income that helps you sort of pay with the mortgage. What I like to say is if you're a first home buyer, it makes a lot of sense to buy a home and income because you're essentially buying two properties, right? You're buying your own occupied and an investment, and you only need to put in 20% deposit. So it's not a terrible strategy at all. But obviously, you need to compromise a little bit when it comes to the quality of the house because we're spending more money. We're spreading our money into two properties rather than in one.
Oh, and I just thinking about house hacking, because there were two cases where I was super proud of the client and the result that they got. One was actually a church pastor. They were thinking about they don't have that much income, but they don't mind having something a bit older. And as long as, they don't have to commit too much, because obviously you have to have that flexibility as a pastor doing that kind of work, that line of work. So we ended up buying this property that has 3 dwellings on it. Most banks came back to us saying hey, realistically, this is an investment property. You've got 2 minor dwelling. You essentially got 3 incomes, right? If you rented the whole thing out. And miraculously, we had one bank come back and gave us 80% on that. And I was just stoked for the client because that's like house hacking at its finest. Because now you've got pretty much a free mortgage. Like you don't have to pay for it because you got 2 extra income coming in. And then the other one was similar situation. They're not like a pastor, but they were doing a lot of not-for-profit things. Maybe like just good things happen to those people. But we got a 7-bedroom home. 2 of them is a minor dwelling, in a minor dwelling, and then 5-bedroom. And basically, him and his sister, they rented out 5 bedrooms, and we worked out the maths at the time. I remember it was cash flow positive on day one. So we bought like a 1.6 mil property because they had some inheritance, and they didn't have to pay for the mortgage. So I was really, really stoked with the results. So where would we place the strategy, you reckon?
I would around the A or B personally. I think it also depends on the individual. Sometimes it could even be a S. It just really depends.
Now, why would I put in an S? It's because if you look at investment properties, if you buy it as investment, first of all, you have to put 35% deposit. Secondly, if you change your mind, you're like, I don't want this property anymore, I need my money back, you sell it. Any capital gains, you have to obviously pay tax. But house hacking strategy, you're buying it as a house that you're going to live in. And so there's the advantage of buying an own occupied, where if you built the equity, you're not necessarily having to pay tax on it. Now, don't quote me, I'm not an accountant, but my understanding of the tax policy is that if you're living in it, you buy an own occupied, then potentially you're not having to pay tax, upon sale. So that's why I think for a investor, sort of first home buyer with that mindset of, this is my first home and it's not my last one, it's a S-tier strategy. We can obviously change that if you think otherwise.
I think it makes sense. Yes, there. I mean, it's not going to apply to everyone, obviously. Like if you're already an established investor, then this is not really going to be a strategy that's going to work for you. But yeah, it just depends where you are in your investment journey. If you're starting out, then this is definitely an S, I would say.
The next one is a central do-up strategy. So this is looking at your units or like cross-lease property, or sometimes it's freehold. Maybe houses that built long time ago where the floor plan is not well utilized. You could potentially add an ensuite. You can potentially change the kitchen into a extra bedroom, and then just have an open plan area for the lounge. And this way you are generating both equity and income on the rental. This strategy in central, the yield is not going to look as good as, say, for example, a minor dwelling strategy or regional cash flow. However, if you buy the property, if you do it well, you are getting increase in yield and increase in equity. Anything to add on that?
Yeah, I think you've covered everything there. But with that strategy, it also depends on what your intention is. If you're looking at holding that property or if you're looking at flipping it, what are we assuming here, Landon? Are we assuming we're holding it or?
So I would say we are assuming that we are holding it as part of your portfolio, because at the end of the day, like the goal is to hold the property.
Yeah, I would say in that case, then I would place that in a B or C personally. My reasoning behind that is, even though you do this property, you might create some equity. The cash flow on these properties are likely going to be very terrible. Cheapest unit you're going to buy is maybe $600,000 or so. If you're lucky, maybe a little bit cheaper. But then the end product, yes, you might get some equity, but how much rent can you actually receive from it? If you get anything above like a 5% yield, that's pretty amazing. But I don't think that's quite likely in Auckland.
And the reason why I would put it above new build is because the fact that you can create the equity. So the strategy forces you to buy something that's well below market value, and you're adding value by renovating it or utilizing the floor space. So that's why I would rank it slightly above new build, whereas new build you're more restricted to just buying really well and then looking for capital gains in the long run.
But then the argument is that you're not going to have the tax deductibility, right?
That is 100% right. So you are going to have, you have to fork out a bit more to compensate for that. And saying that, you could still look for social housing contract, and then also you're likely to have more yield than a new build. So those are the things that you have going for it. In terms of a holding strategy, especially in this current interest rate environment, sort of like below the best strategy, just because, it's not going to be cash flow positive. The next one we could look at is multi-unit. So this is buying properties that have multiple dwelling, and Zhiyang has a couple of these. So maybe you can tell us a little bit more about the strategy.
Yeah, so multi-units is essentially what you chase. It's pretty similar to the regional cash flow strategy. However, you're sort of, in one transaction, you're buying a lot more than one. You might buy 4 units on one title, maybe 5, maybe 6. Basically, you're chasing the yields for these. You want sort of the, minimum 8, 9, ideally maybe 10 plus. That's what you're chasing for these sort of properties. You're going to find these in the regions all over North Island, just not in the big cities, obviously, not Wellington, Auckland, or Hamilton, but everywhere else you'll be able to find these sort of properties.
So cash flow, we got capital gains, decent. We're still looking in major cities. Capital improvement.
Yeah, it's definitely there, because with capital improvement, right, it's about the value. You're trying to increase the value by maybe making some renos in the properties. A lot of these properties, the actual value of these properties are derived from the cash flow it's generating. It's quite likely you could do a bit of renovations on these properties. You might be charging, let's just say, like my example that I bought in Timaru, that was renting out for $220 per week for each unit when I first bought it. And I spent maybe around $20,000 on each of the units. There was 6 units. And now we're renting it out for around $320 a week for each of them. When the valuer comes in, the initial valuation that the valuer did, they based the valuation on the cap rate. So essentially the yield of the property. So if they do one again now, they will still base the valuation of the cap rate. And because now the income has increased significantly, they will basically look at the new income and give us a new valuation. So there's still a lot of scope for capital improvement on these properties, I would say.
Yeah. So essentially, you've got everything in these property. And what's really interesting as a insight to buying these is because when you buy them, a lot of people, they don't really need to sell it. It's cash flow positive. They're getting good rent. They had it for a few years. And the reason why they're getting rid of it is like, okay, they just can't be bothered anymore. They're probably cashing up. And so I would say good 70% of these, come run down because they just can't be bothered. They're not looking for maximum dollar. So you have a bit of margin in there. So where would you rank this?
I would say either Uber or S. It also depends on where you are. But like if you're an investor who has a lot of equity, then I would say it's definitely Uber, because you don't have to commit, well, you're committing a small portion of your equity to buy this. It doesn't require you to put in any cash week on week. So I'd say, overall Uber. What do you think?
I definitely agree, because if I go, okay, well, if we put regional cash flow at S, house hacking at S, multi-units has to be Uber. Like that strategy is better, because if you look at the numbers on paper, multi-unit, if you look at cash on cash return, if you look at return on equity, look at your gross yield, all the numbers will be stronger than everything that's below it. And because with the numbers that are stronger, even though you might need a higher deposit at the bank, you can attract capital easier because the numbers are stronger. So that's why I would say Uber. Now, looking at the last two, and I want to perhaps maybe just end on these as a one strategy, right? We got the land banking and subdividing to hold, right? Land banking is essentially buying central city properties where the land is subdividable. And so we're looking for something that's pretty much subdividable straight away, and you can build multiple houses on it, and you're just potentially just holding the property, or you're holding it so that you can develop in the future, or you can just buy something that you develop to build and then sell it. That's the other type of strategy. Maybe you can tell us a little bit more about like the stats on these. Like what's the opportunity here, Zhiyang?
Yeah, if we look at the subdivide to build strategy first, usually, like you're committing a good chunk of equity to hold a property if you're just land banking. But obviously if you're subdividing to build, usually, you're chasing that, 20 to 30% margin, right? So it's going to cost you, let's say it's going to cost you $4 million, right, to complete a subdivision. You might want to have at least $800,000 to maybe $1.2 million of gross profit. It's a big commitment. It does require a lot of equity. It does come at risk as well, obviously, because there's a lot of investors out there, a lot of developers out there who actually go for the strategy, but because of the market or because they haven't calculated the numbers, they don't have that margin of safety. They actually might not actually make too much money. You're locking up a significant amount of your equity into these sort of deals. So I would say for an experienced developer, this would be a very good strategy. If you're new to the game, depends on the deal, obviously.
But if Zhiyang brings you the deal and like, man, you need to settle this, then you just sign the contract. That's what happened to a few of his mates. So land banking and subdividing to hold, I would say, if you can have the mindset of holding it long term, I definitely probably rank it higher, near the S tier, because you've got really good capital improvement. Although where it's lacking is like you need to buy a good piece of land. And you need to buy well. Subdivide to build, I think, because your margins can erode so quickly if you don't do your calculations well, the expert knowledge required to do this well is significantly higher. But the reward is massive because, in a land banking strategy, your capital gains is multiplied based on how many future dwellings you can build, right? Listen to this again. It's like if you buy a normal property, right? You got the 6-7% gains, right? But a land bank, you have a multiplier effect, right? When we play games, like, when we look at damage multipliers, like there's the thing that you always look for. And land banks have one of the best multipliers, because the more dwellings you can build on it, the more capital gains you're going to get long term. And if there's a unitary plan change like Auckland had, that's why there were so many properties that doubled in value, because the multiplier effects just like went from 2-story to 4-story. It's like, how many more floor areas can you build, right? Massive. The opportunity is potentially massive, but you do need to understand the risk, which is like you don't have much cash flow, you have to have a lot of cash flow, and you need to understand, have some expert knowledge around, what is good subdividable property. That sort of concludes our tier list. Anything you would change after we have put all of these up?
I personally, with subdividing to hold, I'm not a huge fan of it.
So you would derank them?
I probably would derank that, just because, like if you're subdividing to hold, the amount of equity you're committing to this is substantial. What's the true yield you're going to get? Like, for example, if you compare a multi-unit strategy to a subdivide to hold, right? Like a multi-unit strategy, you might get 10%, 11% yield potentially. Subdivide to hold, you're looking at, the yield on cost could be anywhere from 4 to 6% at the very most.
That's such a good point. So that's such a good point that Zhiyang has made here, because when I'm talking about land banking, I'm just talking about, okay, you're banking a piece of land that you hold long term and you can survive the negative cash flow. The downside is you have to put in way more cash to make it cash flow neutral. And the upside is obviously the multiplier effect. But the downside to subdividing to hold is not that good of a strategy, because the yield is usually way lower than the S tier and the Uber tier strategy that we have above it. So, we have all these dreams about like, oh, we're going to have this piece of land and build houses in the future. But then the yield is so low, you actually want to maybe take advantage of the bright line test to make it worthwhile. I guess what would allow it to be pulled up to the next rank is just the fact that it's a very good capital gains short strategy, because you're getting a lot more equity. But long-term hold, maybe you wouldn't subdivide to hold. You probably subdivide hold for a while until your accountant's like, hey, you can sell these without tax. Then you've got a really, really solid strategy there. So there you have it, folks. I'm going to keep today's podcast in there, and hopefully you have found some good value. And of course, if you guys want to learn more, subscribe to our YouTube channel, check out our Leverage Addict podcast. And if you have found value today, please share this episode with just one person that you think will learn something from it as well. Thank you for listening. I'll see you guys in the next episode. Thank you, Zhiyang.
Thank you, Blennon.